Chapter 1. The Silent Killers. Why Most Traders Fail. Introduction. Trend promises freedom, the ability to work from anywhere, financial independence, and a life without a boss. Yet, despite these tempting prospects, statistics show that 90% of traders lose money. For many, it's not a matter of luck or market conditions alone. It's how they approach trading that seals their fate. In this chapter, we dive deep into why most traders lose money, uncover the common psychological traps, behavioral mistakes, and system errors. Understanding these silent killers is the first step toward fixing them and setting yourself on a path to consistent profits. 1.1 The psychological traps that destroy traders' fear. The biggest enemy: fear, a primal emotion designed to protect us, but in trading, it can paralyze you. Imagine a trader who opens a position, sees the price move against them just a bit, and immediately exits to avoid losing more. That early exit may prevent a big loss, but it also cuts potential profits short. Fear of losing money often leads traders to set tight stops or exit early. This fear causes premature selling. Sellers panic and trigger price drops. Fear can also prevent a trader from entering a trade altogether, causing missed opportunities. Example: Sarah is a new trader who places a buy order on a currency pair. The price drops 10 pips against her, and she closes the trade, missing the subsequent 100 pip rally. Her fear cost her a profitable trade. Greed. The desire for quick riches. Greed pushes traders to take excessive risks or hold onto winning trades too long, hoping for even bigger profits. Trying to double down after a loss or chasing large profits is common. Greed can lead to over-leveraging and risking large portions of capital. Example: John loses $300 on a trade and tries to recover by risking $1,000 on the next, ignoring risk limits. His greed causes bigger losses. Revenge trading. A vicious cycle. Revenge trading is the act of entering new trades impulsively to recover losses. This emotional reaction often leads to poor decisions and bigger losses. Traders lose objectivity after a bad trade. Revenge trading typically violates risk rules and strategy discipline. Example: After losing a position, Emma impulsively enters 3 trades in quick succession to win it all back, increasing her drawdown drastically. Overconfidence. The hidden risk. After a string of wins, traders can become overconfident, increasing position sizes and ignoring risk management. Overconfidence leads to taking trades outside of the plan. It often results in large, unexpected losses. 1. To overtrading and lack of discipline. Many traders believe that being active in the market all day will make them more profitable. This belief often leads to overtrading. Overtrading increases transaction costs. It often means entering low-quality trades. Emotional fatigue sets in, reducing judgment quality. Example: Mark, excited after a winning streak, begins taking multiple trades a day without proper setups, leading to a series of losses. How to fix it? Focus on quality over quantity. Wait patiently for high-probability setups and avoid trading out of boredom. 1.3 The illusion of quick money. Social media and fake guru. Social media platforms are filled with flashy images and videos of traders celebrating massive wins. However, this portrayal is often misleading. Many gurus cherry-pick their best trades and hide their losses. Followers emulate risky behavior without understanding the background. Unrealistic expectations lead to impulsive decisions and big losses. Tip: Always approach social media trading advice critically. Practice strategies yourself before risking money. 1. For poor risk management. The number 1 cause of failure. Risk management is the foundation of long-term success in trading. Most losing traders risk too much capital on single trades. The 1% risk rule advises never risking more than 1% of your total capital per trade. Without strict risk limits, a few bad trades can wipe out your account. Example: Lucy risks 10% of her capital on one trade. After 3 losses, She is nearly wiped out. Why risk management matters: protects your capital from catastrophic losses, enables surviving losing streaks, allows compounding profits safely. 1.5 No system, no edge. Trading without a plan is gambling. Trading without a tested system is like throwing dice. Many traders rely on tips, random indicators, or gut feelings. A trading system includes entry and exit rules, risk parameters, and trade management. Without an edge, the odds are against you. Case study: Joe trades based on daily hunches and ends every month with a loss. 1.6 Lack of education and mentorship. Most new traders jump into the market with little or no formal education. They rely on free videos or hearsay. They don't understand market structure, psychology, or risk. Mentorship accelerates learning and prevents costly mistakes. Solution: invest in quality education and seek experienced mentors. 1.7 Common myths and false beliefs. Myth 1: more trades equals more profits. Truth: quality trades, not quantity, generate profits. Myth 2: indicators guarantee success. Truth: indicators lag and can give false signals. Price action is more reliable. Myth 3: you can get rich quickly. Truth: trading is a skill developed over years with discipline and patience. 1.8 Summary: fixes to stop losing money. Develop emotional awareness and avoid impulsive trades. Strictly follow risk management 1% rule. Trade only high-quality setups. Avoid overtrading. Build or adopt a tested trading system. Educate yourself continuously. Avoid following social media hype blindly. Seek mentors or joint trading communities for support. Practical exercise: self-assessment checklist. Do I have a written trading plan? Do I risk more than 1% of my capital per trade? Do I keep a trading journal? Am I trading out of boredom or emotion? Have I studied trading psychology? Do I have a mentor or community for support? If you answered no to any, focus on fixing these areas before risking more capital. This chapter sets the foundation for your journey to profitable trading by revealing the common pitfalls. Next, we'll explore how winning traders develop the right mindset to overcome these challenges. Chapter 2: the mind of a winning trader. Introductional systems and strategies are essential. It's your mindset that determines your success or failure. Trading is as much a psychological battle as it is a technical one. This chapter dives into how winning traders think, behave, and manage their emotions to stay consistent and profitable over time. 1. Building emotional resilience. Trading is a roller coaster of emotions. Losses, unexpected market moves, and uncertainty test your nerves constantly. Emotional resilience means bouncing back from losses without letting frustration or despair affect your next decisions. Techniques like meditation, deep breathing, and maintaining a healthy lifestyle support emotional balance. Example: successful traders often meditate before trading sessions to center themselves and reduce stress. To thinking in probabilities, not outcomes. No trade is a sure bet. Winning traders focus on probabilities and expectancy. Each trade is like a coin toss, but the odds are stacked slightly in your favor with a good system. Accept that losses will happen, but over many trades, the edge leads to profits. Example: a trader with a 55% win rate and 1.5 to 1 reward to risk ratio will make money in the long run despite some losing trades. 3. Mastering patience and boredom. Good trading often requires waiting for the right setups. This means sitting on your hands for long periods. Most traders struggle with boredom and impatience, leading to premature or impulsive trades. Patience is a superpower. It prevents chasing bad trades and helps protect capital. Tip: use this waiting time for journaling, reviewing the market, or learning more. For journaling and post-trade analysis. Keeping a trading journal, a powerful habit that separates winners from losers. Record every trade setup, entry, exit, emotions, and lessons. Review your journal weekly to identify recurring mistakes and adjust strategies. Example: Traders who journal report improved discipline and awareness of emotional triggers. 5. Detaching self-worth from trade outcomes. Your value as a person is tied to your P&L. This detachment is crucial. Losing trades don't make you a failure. Avoid emotional swings from wins or losses. Maintain steady confidence and humility. 6. Embracing losses and managing tilt is a term from poker describing emotional upset leading to reckless decisions. Every trader faces losses. It's how you respond that matters. After a loss, take a break, breathe, and reset your mindset. Avoid revenge trading or overcompensating. 7. Discipline versus motivation. Motivation fluctuates, but discipline, consistent habits, wins. Create routines to automate good trading behaviors. Use reminders, alarms, or checklists to stay on track. Treat trading like a job with scheduled sessions. 8 Fixes and practical tips. Develop a pre-trade checklist to ensure you're mentally prepared. Use mental rehearsal. Visualize your trades and reactions before the market opens. Practice mindfulness. To stay present and reduce impulsivity, set daily intentions to focus on process, not just profits. Chapter 3. Building a profitable trading system. Introduction. Profitable trading system is your blueprint. It provides structure, defines rules, and creates an edge that gives you a statistical advantage. This chapter breaks down how to build, test, and refine your own system. 3.1 What is an edge? Your edge is a unique advantage that leads to profitability. Can be a pattern, indicator combination, or price action signal. Must have positive expectancy over many trades. Example, a system that wins 60% of the time with 1-to-1 risk-reward ratio. Has a positive expectancy. 3. To price action versus indicator-based strategies. Price action focuses on reading raw charts, support, resistance, candlestick patterns, market structure. Indicators like RSI, MACD are tools based on past price data, which may lag. Price action tends to be more reliable, but many traders combine both. 3. Backtesting and forward testing. Backtesting, applying your strategy to historical data too. Measure performance. Use at least several hundred trades to get meaningful stats. Beware of curve fitting over optimizing for past data. Forward testing. Demo trading live markets in real time. 3. For journaling trades and Capistrack. Win rate % average win. Loss size risk-reward ratio maximum drawdown expectancy per trade. Analyze monthly to improve. 3. 5 Risk-reward optimization. Aiming for at least 1-to-2 risk-reward means you make twice as much on winners as you lose on losers. Cut losses quickly. Let winners run within your strategy. 3. 6 Tools to track and test free. TradingView, Excel Paid, NinjaTrader, MetaTrader. TradStation Autumn as much as possible. 3. 7 Strategy checklist for market types. Trending markets, trend following strategies, range-bound markets, mean reversion volatile markets, scalping or wider stops. 3.8 Examples of proven strategies. Forex breakout. Enter after a candle closes above resistance with stop below. Crypto scalping. Trade small profits on low time frames. Stock swing. Moving average crossover confirmation plus volume spike. 3. 9 Fixes and takeaway. Start with simple strategies and master them. Avoid chasing every new system. Always test before risking real money. Keep improving based on data. Chapter 4. The real path to consistency and profit. Introduction. You have the right mindset and system. The key is consistency, trading like a business, managing capital, and setting realistic goals. 1. The compound effect of consistency. Constant small gains compound into big growth. Example, 1% daily gain compounded over 250 trading days equals $12.03 return on $1 invested. This beats chasing huge, risky wins. For daily, weekly, monthly review systems. Daily, record trades, emotions, and adherence to plan. Weekly, analyze results, Tweak small things. Monthly, deep dive into performance metrics. Adjust goals. For 3 setting realistic income targets. Avoid expecting to double your account every month. Set targets that match your system's expectancy and risk. Build confidence gradually. For avoiding burnout, take regular breaks. Balance trading with other activities. Limit screen time and reduce stress. For 5 trading as a business. Track all expenses and taxes. Separate trading capital from personal funds. Reinvest profits wisely. Understand tax rules in your country. For 6 building multiple income streams. Signal services or newsletters, coaching or courses. Trading funded accounts to access larger capital. For 7 surviving bear markets and black swans. Use hedging and diversification. Have contingency plans. Keep extra cash reserves. For 8 fixes and takeaways. Automate alerts for setups. Scale position sizes slowly. Plan an exit strategy. Retirement, changing careers. Summary trading success comes from mastering your psychology, building a tested system, and managing your business consistently. By applying these principles, you reduce the odds of losing and increase your chances of sustainable profits.